Hello, everyone, and welcome to the third webinar in Fasken's 2023 Quarterly Perspectives on Tax Law series titled 2023 Tax Update for Mergers and Acquisitions. My name is Hardeep Gill, and I'm a partner in Fasken's tax practice group, and I'm based in our Vancouver office. My practice includes advising clients on a broad array of income tax and other tax matters. I advise clients in the course of complex commercial reorganizations, transactional matters, disputes with tax authorities, and other business tax matters. I'm joined by my colleague, Michael Coburn, who is also a partner in Fasken's tax practice group in Vancouver. Mike's practice includes advising Canadian and international clients on a broad range of tax matters. Clients look to Mike for his extensive experience with a myriad of tax issues, including the tax implications of structuring of mergers and acquisitions, corporate reorganizations, financings, and other business transactions. We will be focusing our presentation on recent tax developments which may impact M&A transactions and be of interest to anyone engaged in issues relating to the purchase of or sale of a business. So as we go, please submit any questions via the Q&A box on the right-hand side of your screen, and we will try to get to as many of them as we can at the end. Okay, and now on to our presentation. So we'll proceed by first discussing recent developments in tax disclosure rules. So here, there's the mandatory disclosure rules, which have been talked about for a while, which proposals have come up for some time, and these were recently enacted. And there's Bare Trust reporting rules, which, same thing, they were recently put in place. After that, we'll talk about three relevant cases. So one at the Federal Court of Appeal, and one at the Tax Court, and one at the Ontario Court of Appeal that are relevant to tax issues that arise in M&A. And then we'll move to amendments that expand the income tax GAR. And finally, miscellaneous topics, which today will be international sales tax concerns that may be relevant to M&A. And now I turn it over to Mike to speak about mandatory disclosure rules.
Thank you, Hardeep. And yeah, this is recent developments in M&A. And for those of you who follow these quarterly perspectives, and I assume that's most of the audience, you might recall that I actually talked about reportable transactions at a presentation I gave. I think it was in the fall of last year as part of this series. So you might be saying, well, it doesn't sound recent to me. But in fact, it is recent because we now have actual law in place. When we were talking about this last year, the law was, it's been jumped around a bit. It was first introduced in 2022 in the spring, and then there was a lot of concern, and so the government delayed the enaction, and it was supposed to come in January 1st of this year, and they delayed it some more, again, changed the rules a little bit. But as of June 22nd, 2023, these rules are now law. So we have to deal with them, and we are dealing with them. And in my view, this is one of the more significant developments on the tax side of M&A, in the past several years. And that's why we really have been focused on it, and we'll continue to discuss it as long as we don't have clarity on some things and are working through some of the issues, which we'll talk about today. The rules aren't entirely new. They're based on what were pre-existing rules, but they were significantly expanded. And to give a sense of the scope of that, in my previous 22 years of practice, I think I dealt with these rules once. And basically, in every deal that I've been involved in since June 22nd, I've at least had to think about the rules. And in several of those deals, kind of think about them for a significant period of time and take certain actions on them. So really, they have been changed in a pretty fundamental way. We do emphasize, I always sometimes, lose the focus on this a bit. This is a reporting requirement. That's really all it is at the end of the day. You're not admitting any liability through these rules. You're not acknowledging anything or anything else. But it is an obligation to report to the CRA. And if you fail to report, the consequences are pretty serious, both in terms of monetary penalties and other sanctions, and we'll talk about that. And again, I emphasize, we now live in a world with these rules. These are the law. This is the law. The first sort of category of rules is reportable transactions. And there are sort of, as with many tax rules, some sort of gating issues that you have to, meet in order to fall within the rules. The first is you have to have an avoidance transaction. And I think that can be a little bit misleading because when people hear an avoidance transaction, they think that you've done something, a bit nefarious or really complex. And that's really not how the definition works. It really basically says if you've taken a step and one of the main purposes of that step is to obtain a tax benefit, you've got an avoidance transaction. So there's no sort of morality in here. And in fact, the tax benefit that you might have realized might be contemplated by the Tax Act. As many of you might know, the Tax Act has all sorts of rollover provisions. Well, if you get into a transaction and you take a step to take advantage of one of those rollover provisions, you probably have a tax benefit, and therefore you have an avoidance transaction for the purposes of these rules. So I think in a lot of circumstances, this is going to be a test that a lot of transactions will meet. Which leads us to the hallmarks, which is kind of the core element of these rules. And the idea is that to fall under these rules and to have to file a report, you need one of the hallmarks. And that was one of the big changes from the old rules, which had sort of similar hallmarks. They've changed a bit, but you needed two of the hallmarks under the old rules. And I think, as we'll see, it's probably a somewhat rare transaction that has two, but one is much more common, hence the reason why we never used to deal with these rules, and now we deal with them all the time. So the three hallmarks are whether or not you have a contingent fee, confidential protection, and contractual protection. So again, you need one of these things. I'll walk through each of these in a little bit more detail. So the contingent fee is a fee, as you might expect, that's paid, that's based on a criteria. And the criteria that could trigger it is if the fee is based on the amount of a tax benefit that results from the avoidance transaction, or the success of the avoidance transaction, or the number of people who participate in the avoidance transaction. So where you might see these, and again, I haven't run into it too much in my career, but there are folks out there that will offer products, so to speak, that will say, listen, if you do this, we think it'll save you X, and we'll base our fee on that. Or if you can get a certain people to commit to undertaking this transaction, which is tax-driven, we'll base a fee on that. And again, this would not be something that I would normally anticipate would arise in a typical M&A transaction. This would be something that would be more tax-focused. And the CRA has also provided that confirm that this would not include standard fees and fees based on the value of services provided. So as I say, I don't think this is probably the hallmark that's going to cause us a lot of concern in M&A. Similarly, I don't think confidential protection is going to be a huge issue in that it's a little bit different than what you might think. It doesn't mean that there's confidential protection out there, you fall within these rules. It's aimed at confidential protection that is obtained by advisors or promoters. And so again, the sort of classic example of this is the same folk I mentioned earlier who might go around sort of advocating products might say, well, before I tell you what this product is, I want you to sign a non-disclosure agreement, or I want you to sign an agreement that promises that you'll never tell anyone about this. That's the type of confidential protections that largely these rules are focused on. And again, that isn't the type of thing that I've typically seen in M&A deals. There's all sorts of confidentiality in NDAs around deals, but that's usually protecting the parties who are participating in the deal, not the advisors. And so, and again, the CRA has provided some helpful exclusions with respect to trade secrets and other ordinary course sort of confidentiality provisions. So again, this isn't where I think we're probably going to have to deal with these rules, which leaves us with contractual protection, which is the one that I think is going to be significant or has been significant in M&A so far. So contractual protection includes any form of insurance, an indemnity, compensation, guarantee, or other protection in respect of an arrangement containing an avoidance transaction that either protects a person against a failure to achieve the tax benefit or reimburses losses. And then there are both statutory exclusions for standard, and I'm emphasizing standard there, standard reps, warranties, and guarantees, and standard professional liability insurance. Those do not constitute contractual protection. So where in the M&A context we would expect this would often arise is in the indemnity side. And in my experience, it's very common for an acquirer to insist on robust tax indemnities. And to the extent that seller has undertaken pre-closing planning, there is often specific tax indemnities that are addressing that specific planning. And that's where we think, we're going to see these rules arise more often than not, is on the contractual protection side. Because again, and this is one of the things that we're working through, as I say, and looking for clarity on, and we'll likely be talking about these rules more. the CRA so far hasn't given too much guidance as to what constitutes standard reps, warranties, and guarantees. And so, given the lack of guidance there, I think there are different views as to what that constitutes. And where, but the CRA has, in addition to the statutory sort of exceptions, given some guidance, which isn't necessarily binding. It's always important to remember that, but they've given some guidance as to where they think, what might be contractual protection and what might not be. And helpfully, they've said it wouldn't be an indemnity relating to existing pre-closing tax issues. So again, in an M&A deal, to the extent that the indemnity is limited to, what had happened prior to closing, we would anticipate that wouldn't be contractual protection. Similarly, tax insurance protecting a purchaser against liability on taxable Canadian property and some other specifics are also standard price adjustment clauses have been identified as not constituting contractual protection. So that is helpful, and I think is reduced some of the anxiety we have over these rules, but it hasn't eliminated it because the CRA has also said that tax insurance obtained in respect of specific identified tax risks in an M&A transaction is not excluded. And in fact, that the existence of such insurance may often be an indication of aggressive tax planning. In addition, we sort of would draw from this a view that a specific tax indemnity would also cause concern from the CRA. So this goes back to my earlier comment about, if you've got a vendor who has undertaken tax planning specifically in contemplation of a transaction, and and that vendor agrees to provide an indemnity with respect to that planning, or you go out and obtain insurance with respect to that planning, that would seem to be contractual protection and would therefore trigger the rules. And in my experience, that fact pattern arises not infrequently in M&A transactions. So, what happens if you are in the rules? Well, you have to file a form. As I said at the outset, this is basically a filing obligation. But again, in a significant change from the original rules, under the original rules, only one person had to file a form. It was effectively the person that realized the tax benefit. Now that obligation is extended, and it includes everyone who obtains a tax benefit, everyone who enters into a transaction for the benefit of a person who is receiving a tax benefit, and every advisor or promoter in respect of the reportable transaction that is either entitled to a contingency fee or certain contractual protection. So again, in a typical deal, when we think the rules apply and then we sit down and try to figure out who actually has to report, in my experience, that process has often led to a conclusion that kind of everyone who has touched the file in a meaningful way, and that would include the buyer, the target, potentially the shareholders of the target, the advisors, both legal, and I'll talk a little bit about the special circumstances of legal in a minute, and the accounting advisors. And that's all because, effectively the advisors typically are providing some advice with respect to the contractual protection, so that brings them into it. And then the counterparties are typically parties to the share purchase agreement or plan of arrangement or whatever the agreement is that the tax benefit results from, so they're brought in. And I think there's also a pragmatic side to this, that once one party files, there's a strong sort of sense of, well, everyone might as well file because, the cat's out of the bag, so to speak, and the CRA will know because the filing will require you to list all of the parties involved. So that often is, I think, how these discussions sort of evolve. The due date for filing is not a particularly long one. It's 90 days after the day on which the parties entered the reportable transaction. So this is something that you have to act on fairly quickly, and we'll talk a little bit about that at the outset of this section. Penalties are always important to think about penalties, and they're significant. The monetary penalties can be up to 25% of the tax benefit. So if you're talking a big savings, that could be a big number. For advisors, it could be up to $100,000 or your fees. So these are significant monetary penalties. In addition, if you don't report, the statute of limitations, which is the period under which the CRA could challenge your deal, is extended. So that's often almost as significant a development in terms of, often when you undertake some planning, you think, well, after a certain period of time, the government can't challenge my planning. These rules extend that period of time. Also, you're precluded from using certain defenses against the application of the general anti-avoidance rule, which we'll talk a little bit about later today. So fairly heavy sanctions for non-reporting here. And that often, again, leads to sort of a discussion, in my experience, of if you're uncertain, why not file? And again, it is inconvenient and a hassle, but given the consequences of not filing, and again, the fact that filing isn't any sort of admission of anything, although one would assume it's probably, going to lead to an audit. I think that would be a fair assumption that you are going to get further inquiries from the CRA. But again, under the sort of cost-benefit analysis, I think has often led to people reporting where there's any uncertainty. Okay, notifiable transactions is the second category. I'm not going to go through that, but basically in any great detail. But basically what the government seems to have done is saying, well, in addition to sort of the unknown stuff that we would want you to report under the reportable transactions, there's a bunch of stuff that we know about and we want you to tell us about it. And so they've come up with a construct, which I think other countries have used, including the UK, where the idea is that they will eventually list certain types of transactions and say, if you undertake one of those transactions, you have to tell us. We're eliminating any sort of analysis involved in whether you have to, like you do have to. At this point, they haven't provided an official list yet, but they have indicated informally what they're likely going to include in the official list. And we have an example a list of that in the next slide. I'm not going to go through this in any detail. If anyone has any questions on it, feel free to enter them. But as I say, the list here basically consists of fairly well-known tax plans that the CRA has dealt with in the past and has some concerns with. And they've indicated this is the type of thing that they're going to list, as something that if you do this, you have to report, sort of full stop. The process for filing notifiable transaction returns is very similar to the reportable transactions. The time frame is similar. The parties who have to file is similar, probably even a little bit more expansive in terms of, I think the notifiables bring in the advisors in a bit of a clearer way than the reportable does, but a lot of overlap there. Penalties, again, we're talking similar, large amounts, minimum sort of greater of 100,000 and 25% of the tax benefit, advisors fees and up to $100,000. So again, fairly significant financial penalties for failing to report. Yeah, recent developments. So since their very first enactment, and particularly the idea that lawyers were going to have to file a return under their name that basically reports the activities of their clients, lawyers have had real concerns about these rules and have expressed them since day one in a number of quite forceful submissions to the Department of Finance, who's responsible for drafting these rules. And there have been some concessions to that. There is an exception in the rules to information that is subject to solicitor-client privilege, but that exception is not entirely clear. And I think out of the ongoing uncertainty, a consortium of law societies of Canada applied a few weeks ago for an order from the Supreme Court here in BC, basically excluding the application of the rules to lawyers, paralegals, and other legal professionals until either the court looks at this further or November 20, 2023. So as of today, lawyers, paralegals, and other legal professionals across Canada, and even though this ruling was just in BC, extended across Canada, are not required to file reportable transaction forms. So that's an important development. Again, it only applies to that group. Everyone else, this is the law, but this group for now at least is exempted. But that exemption, as I say, could end by November 20th, 2003, depending on how things develop. So stay tuned. Takeaways. As I said, we're quickly evolving into having to deal with these concepts in the context of M&A deals, and that is sort of represented in a few ways. One, we're increasingly seeing reps and warranties from the parties confirming that they're not undertaking any transactions that could qualify as a reportable or notifiable transaction. And then, of course, to the extent that's not true, we then have provisions that detail the process for reporting. And so generally, again, because of the breadth of these rules, those provisions usually involve the parties meeting, trying to agree in good faith as to what's to be reported, dispute resolution mechanisms within there as well, and can actually get quite detailed so as to ensure that proper reporting is done. And again, as part of the process, of course, we then have to evaluate whether any pre-closing planning constitutes or triggers these reporting requirements. So as I say, this has definitely impacted the tax practice when it comes to M&A and will continue for the foreseeable future. I don't think, again, while lawyers may be successful in getting themselves from under these rules, I find it's highly unlikely that non-lawyers will be exempted. This originates from the OECD and Canada's commitment to tax fairness, and I think it's unlikely that these rules are going to go anywhere soon. So to go from kind of the proverbial frying pan to the fire, I'm going to turn it over to Hardeep to talk about the new trust reporting rules.
Thanks, Mike. So continuing the theme of greater reporting obligations. Historically, under the Income Tax Act, bear trusts, which are bear trusteer nominees, which are effectively arrangements where one party might be holding title to property but have no real rights in respect of that property on behalf of other people who are actually the beneficial owners in respect of that property. So, for example, somebody's on title to property but is not the actual owner. The actual owner is like somebody who paid for the property and simply didn't register their names on it. So that, as an example. For income tax purposes, such an arrangement called a bear trust was not actually deemed to be a trust for either calculation of tax payable by the nominal owner or for purposes of reporting. So what these rules, like what the changes to these rules do is that they make it so that the reporting part of that will go away. So for the purposes of reporting, bear trusts will be considered trusts. But for all other purposes, they're not trusts. This will mean that the bear trustee has to now report, file a T3 tax return, and report the property in the trust. Just backing up a bit, this legislation has been in the works for a while. They've wanted to put something in place regarding enhanced trust reporting since at least 2017. These followed like some of the priorities of the provinces, which have been like, for example, in BC, have been in parallel pushing for increased transparency into who owns property, shares or in particular real estate. So that was one of the reasons for doing this. And the other is that internationally there's a push to, there are a number of different initiatives for purpose of money laundering or terrorism financing to combating those, as well as tax avoidance. And these rules would bring Canada in line with the recommendations and directives under those international initiatives. Practically, what this means is that bear trusts, so these rules were effective as of the beginning of this year, but they only apply to trusts which have a deemed year end that is after December 30th, 2023. However, all trusts that are in existence, except for a certain few, are deemed to have that year end of December 31. So if there's a bear trust that existed for a period of time in 2023, that trust may have to make a filing in respect of the 2023 tax year. And the filing would have to be done at the end of March of the following year. So there are very few exceptions that are built in to these rules. So the list of exceptions is given in, outright in the Income Tax Act at that subsection 1.2. However, like any express trust must make a filing. So those are trusts that are subject to written instruments and likely also include trusts that are oral trusts. So where there is no written instrument, but the parties have always behaved as if there was a bear trust in place and the beneficial owner is the true owner. And that does happen. So what that does not include is trusts that are effectively equitable trusts, which arise on application of equity, such as resulting trusts or constructive trusts. Usually in the course of a dispute, these trusts might arise. And the exceptions, such that they are, would not apply if a bear trust has been in existence for greater than 3 months, or it holds property that is more valuable and worth more than $50,000. And there are other limitations on that exception as well. But generally, if one of those two situations apply, then the Bear Trust will have to report. So why does this matter for M&A purposes? Well, because of the cavalier way in which Bear Trusts have generally been understood in the income tax context, it may be that there's a lot of non-compliance around this issue. Bear Trusts tend to arise fairly easily, and then they may evaporate fairly easily as well, depending on transactions that are undertaken without being reported. So if that's happened historically, this is looking into the future and future deals. After these rules were put in place, then the non-compliance may mean that there's risk for penalties and interest and all of that. The second reason is that in the course of a deal, often there might be an escrow arrangement, or the purchaser may be holding money in trust for the vendor, and like such arrangement may be considered to be a Bear Trust. And in that case, whoever's holding the property on behalf of the parties may be required to file a Bear Trust return or a T3 return and report. I should note when a Bear Trust files its return, it would not just file the T3 return, but there's a schedule as well that would be attached, which sets out the other parties which may have an interest in the trust, so the beneficiaries, but also those parties that might have some sort of influence over the Bear Trustee. So it might be a fair bit of information that needs to be disclosed about the parties and about the deal in that respect. And we would recommend that deal covenants contemplate sufficient information sharing between the parties to allow that information to be disclosed so that the Bear Trustee can make those disclosures.
I think too, one thing that strikes me about these rules is we've seen this in the past from finance with respect to penalties, because I think they kind of appreciate that a lot of these trusts might not actually have a lot of taxable income, and so they sort of think, okay, well, if you're just holding an asset, for instance, or something like that, and so penalizing them on unpaid tax sometimes doesn't bear much fruit. Mm-hmm. So these penalties include penalties that are based on the asset value yes. of what's held by the trust, and so that can kind of get ugly, because someone might say, well, I've got I'm holding $10 million in some account, but it's barely earning interest. These days probably does earn interest, but it might not be earning interest. I'm not really too worried about it, or it's non-interest bearing or whatever. Like, what do I have to worry about? But again, if there's a 25% penalty on the assets held, you could be looking at a massive penalty, even though really no tax was avoided. So again, getting to your comment about the due diligence, again, the rules are, this is just new, so but in the coming years as we do deals, I think we'll definitely want to be looking to make sure that no one had sort of some undisclosed, unreported Bear Trusts.
Yeah, and in particular in the real estate context, that could be problematic, because if the valuable piece of real estate is held in a Bear Trust, then the amount of the penalty could be quite large.
Yeah.
And I should also note that nominee companies, so these are companies that may not have any income or any other a business except for holding title to a particular piece of property, they'll be required to file both a T2 return, so a regular corporate return, as well as this T3 Bear Trust return. And sometimes that can be overlooked. So now we move to looking at some recent court cases which may impact M&A activity and concern tax issues that sometimes are important for that purpose. So the first case is FOI, which relates to hybrid transactions and anti-surplus stripping. So I'll speak about that one. Mike will discuss the numbered company case, which discusses the differences between an earnout and a reverse earnout, among other things. And then we'll conclude this part of the presentation with Boladon Mineral, which is an Ontario Supreme Court and Ontario Supreme Court of Appeal case, which discusses the interpretation of tax indemnities in a situation where an M&A deal had occurred. So I'll move on to FOI. It's difficult to discuss the facts in this case because for two reasons. One, they're very complicated, and the second is that they're very unusual. I don't think I've ever encountered a situation, a deal where facts of this nature appeared, and we'll get into why. So I don't know that the facts here are the story, but the decision is quite important. for the impact that it might have on potential pre-closing reorganizations or deals which have pre-closing reorganizations or which feature a hybrid asset and share purchase. So in this case, there were the vendor, the target, had two particular principals, Mr. Foy and Mr. Sudi, and they ran a business which its main asset was a piece of software that they had developed, APG, and it was quite valuable. And the purchaser in this case wanted to purchase it for a number of years before that, but they could never agree on the price. The shares were held through two family trusts, the Sudi Trust and the Foy Trust. And LaBelle, that's pictured there, that's Miss LaBelle, Mr. Saudi's spouse. And I should note that W4N, which is the target there, it held significant undistributed income, but it's not clear how much income it actually held. So the decision did not actually set that out. There's actually a number of, typically when you read like a tax case, the facts are relatively clear and they're set out, and the parties will introduce evidence to them. Sometimes the parties will agree as to what the facts are. Here, the parties did not do that. The purchaser didn't actually appear in the trial. It wasn't called. And the vendors were found to be uncooperative. And so there are a number of material facts that aren't quite clear, and which is why it's difficult to say entirely whether the decision is the correct one or not, but which may be. Anyways, so the salient facts for our purposes are in January of 2012, the arm's length purchaser, which is a U.S. company, EMC, approached the principals with a $50 million purchase price for the purchase of 100% of the W4N shares, so the OPCO shares. And there was an LOI that was entered into. So the $50 million price was understood to be okay for the vendors, and they wanted to move forward. Things went so far as to have a draft SPA, which was prepared and circulated between the parties, and it looked like the deal was relatively advanced at that point. However, in April 2012, the deal changed to a hybrid sale of the W4N assets and the sale of all of its shares as well. And the price also changed, which was the most curious of the changes, by $20 million. So it went from a $50 million deal to a $70 million deal in 3 months. The rationale for why there was a change in structure or for why there was a change in price wasn't determined at the court because of the reasons I mentioned. This case was unusual. So it wasn't also clear which party proposed the change in structure. So the hybrid sale took place through an intricate series of steps on May 30th to 31st of that year. I should note, the sale appears to allow optimal tax treatment to Mr. Saudi and Mr. Foy. So likely, it's possible that an asset sale was desired by the purchaser, but they didn't want to lose the capital gains treatment for the vendors. But we can't say for sure because of the issue about missing facts. So the sale proceeded on at the end of May 30th in 4 main steps, which are set out there. There was an initial share purchase. The shares of the 2 trusts were purchased for $2.5 million each. And the next was there was a purchase of assets from W4N by EMC, its acquisition co, for $44 million. And then there was a purchase of, for nominal amount, of all the voting non-participating shares of W4N. And then finally, in 12:30 a.m. on May 31st, there was a purchase of the remaining shares of W4N, and as well as the shares of Mr. Foy's holdco. And at that point, the cash was paid on the promissory notes, with the exception of one note. There was one note left outstanding, which was a key fact that was explored at trial. So the note was for $19.75 million, and so it was never paid down before and in fact, the fact that it was outstanding was the reason why at step 4 the shares of W4N really had any value at all. And so it was effectively repurchased at that point by the purchaser. The purchaser amalgamated the acquisition co and W4N as well as the Mr. Foz holdco immediately afterwards. However, the notes was still outstanding. The vendors took the position in their tax returns that they were able to make use of their lifetime capital gains exemptions, which in 2012 was $800,000, and that they could be claimed on the sale of the shares in steps 1 and 4. It's not clear, like we can't assess whether the lifetime capital gains exemption was available. So that exemption is only available on a sale of shares that are qualified small business corporation shares. And where it's not available, then it's not allowed, and then there is still a capital gain. However, even if it's not available, then those amounts would have been taxed as capital gains. But here, by virtue of the assessment, which was made under Section 84(2) of the Income Tax Act, those amounts were actually treated as dividends paid. Ms. LaBelle, who was the spouse of Mr. Saudi, was also reassessed because when the Saudi trust received purchase proceeds, it allocated them to her, distributed them to her, and also allocated the capital gain to her, which she used her lifetime capital gains exemption on. And then I believe other beneficiaries as well may have been able to use their exemption, but Ms. LaBelle was the one that received the non-taxable part of the capital gain, and so the entire amount that Ms. LaBelle received tax-free was recharacterized. From this, it appears that CRA, in its reassessment, was really concerned about the fact that the lifetime capital gains exemption was used in this situation, and it's not as clear that it was concerned that there was capital gains treatment at all. Okay, so the court decisions. The Tax Court of Canada dismissed the taxpayer's appeal and upheld the reassessment under subsection 84(2). The taxpayers appealed to the Federal Court of Appeal, which also dismissed the appeal in March of this year. They further appealed to the Supreme Court of Canada for leave, but the Supreme Court has not agreed to hear the case yet, and it's not clear that it will, but we'll see. A bit about subsection 84(2). So this provision is a very old provision. It originally was added to the Income Tax Act before capital gains became taxable in Canada. So the reason why it was added was at that time it was very popular to earn income in a company, like significant income, so that the company would have a lot of cash, and then rather than carry out a sale of assets when a sale was contemplated, the company would be sold, the shares of the company would be sold to a purchaser, and the vendor, shareholder, would pay no tax because it was a capital gain, and capital gains were not taxable at that time, like before 1972. So this provision was added, and it says that when there's a corporation resident in Canada whose business is being wound up, discontinued, or reorganized, whose funds or property are distributed or otherwise allocated in any manner whatever to or for the benefit of shareholders, in a situation where the amount of the distribution exceeds the amount of paid-up capital that could correspond to the shares held by that shareholder, then that excess is deemed to be a dividend. Effectively, that's an amount that the correct result should have been that it was paid out as a dividend before the sale took place. So that would be the idea behind the provision. Since capital gains became taxable, like this provision has taken on like new life, and it's continued. And like just roughly the text of the provision is not very large. It's not much more than what you have before you there. But a similar provision that would be put in place today would have pages and pages of detail, detailing how it's to be applied and where. But that's not done here. So roughly, like it's left up to the case law, which is why the implications of the Court of Appeal decision are so important, and why, because of the unusual facts of the case, the facts aren't as perhaps as important. So The Federal Court of Appeal basically confirmed that the line of cases historically that have taken a very broad interpretation of subsection 84.2 is correct and should be applied. And so that finding may lead to further assessments in other more innocuous situations against taxpayers that are involved in deals. And that's why this case it could be, it will be interesting to see where things go from here. So in share deals, it'll be important how excess cash is characterized. For example, if the excess cash is necessary, it's not really excess cash. If it's necessary for the business, then it would it might be considered that it's part of working capital, in which case it's an asset of the business that needs to be transferred, and perhaps capital gains treatment is still available there. But if the parties do agree that an amount is in excess cash, then that could create an issue if there's a hybrid planned and the amount that is on account of a share sale corresponds with the excess. The other thing I'll note is that the decision of the Federal Court of Appeal and also the initial reassessment by CRA, it didn't go as far as it could have. In that the CRA restricted its analysis to only the amounts that seemed to be to which the lifetime capital gains exemption applied, but the analysis that was used and the reasoning could apply to an amount that was much more that was received by the vendors. So effectively, the amount that was received tax-free as a result of a capital dividend paid to them, that could have been reassessed as well. So it could have been quite a bit greater, but it seems like the court restricted its analysis and CRA restricted its analysis to the amount of excess cash and the amount that was used for the lifetime capital gains exemption. We'd recommend that if there is a hybrid share sale that's being planned, that qualified advice should be sought, preferably before even an LOI is agreed to. And now I'll turn it over to Mike to talk about the number company case.
Thanks, Hardeep. Yeah, and just on FWA, I mean, I think that probably it's fair to say it's probably the most important tax decision in the last year or so. And not surprisingly, with a positive decision from their perspective, the CRA is now using FWA as a bit of a fulcrum for audits, and I've seen them go after a number of already completed transactions, citing FWA in trying to recharacterize the tax result from the transaction. And in those transactions that I've seen, the facts were significantly different than they were in FWA. But the CRA, didn't share that view and thinks that the decision applies to it. So certainly if I, had a tax wish list, I think hopefully the Supreme Court will hear the appeal on FWA, because I do think within the tax community and just generally, tax planning around M&A transactions, there's a lot of uncertainty right now, and we could definitely use some clarity. So let's hope that they do decide that it's worth hearing. A slightly less impactful case, but an important one, and also a reminder of a very important concept in M&A deals, is 443-2002 Canada. I'll just call it 443, which deals with earnouts. And earnouts are, as many in the audience probably have experienced, a very important of many M&A transactions. Most deals I see have an earnout component to it. And earnouts are tricky from a tax perspective, and I think this case sort of shows that. So the facts here are that 443 and another party sold their rights and software they developed to an arm's length purchaser under an assignment agreement. The purchase price was payable over 3 years in a combination of a lump sum and earnout amounts. So the lump sums, as often as in this case, the lump sums are actually fairly modest compared to the total amount that could be payable. So $825,000, but the potential via earnout mechanics to get up to $8 million. And this is a key fact that the way the deal was described, it said the total consideration payable was limited to was capped at $8 million maximum. And one of the conditions of the sale was that the principal had to be employed for 3 years following the sale. So after about a year, the purchaser, the principal decided, or maybe the purchaser decided that they didn't want the principal around, or he didn't want to be around. So he wanted to back out. And so, absent any other action, that would have led to a forfeiture of what was described as the earnout. So the principal and purchaser, I gather, negotiated a deal that they would pay him $1.6 million and change as a prepayment for two of the earnout events coming up, and then a final payment of $345,000. So just about $1.95 million in total. So they do that, and the company that received the earnout amounts treated it on account of capital and described it as a reverse earnout. And as such, that treated those amounts as being taxable as capital gains as opposed to income. The CRA steps in and says, no, we don't think those are on account of capital. Instead, we think they're income pursuant to 12(1)(g) of the Tax Act, which talks about payments for the use from property. So they go to court and fight this out, and the court finds in favor of the CRA and determines that the earnout amounts were paid in connection with what 12(1)(g) is to be contemplated here and has to be included in income. So, in terms of the impact of that, it's a big one because, as most of you probably know, capital gains are taxed at a 50% inclusion rate. So on $2 million roughly of payment, the fact that it's taxed as income as opposed to capital gains would have resulted in another, I guess, about $250,000 worth of tax. And so, that, is a problem. And partly why we're talking about this is it seems that there may have been a way to get the reverse earnout treatment had they drafted properly around this. And this isn't a critique on anyone. I don't know any of the details of the agreements or anything else. But again, the fact that the earnout was described as up to a maximum, as opposed to how we would generally do a reverse earnout where we'd say, well, you're going to pay $8 million. That amount can go down if certain conditions aren't met. But the way they had drafted it was structured more so that you could make your way to a maximum of $8 million. So in many ways, a small difference kind of from an economic standpoint, and perhaps no difference from a substantive point of view. But in terms of being able to rely on a reverse earnout, which is generally, if done right, the amounts that you receive under that arrangement are taxable as capital as opposed to income, made a huge difference. I should note, for those of you who are experienced with earnouts, we often don't do reverse earnouts because we do what's called a cost recovery method, and that involves kind of the amounts that kind of come in as they're earned. And that's based on a CRA admin policy, and that is a good policy to rely on. But in this case, they couldn't rely on that because it was an asset sale. And one of the conditions of the cost recovery method, which lets you, again, include as capital as you receive amounts on an earnout, is that it's limited to a sale of shares, but not a sale of assets. So they didn't have that available to them. And as often is the case, when you don't have that available to you, you do look to the reverse earnout as an alternative. But again, the key is if you're going to do that, you've got to structure it so that the maximum amount is the actual purchase price subject to reduction, as opposed to, a smaller price that can increase to $8 million. Now I'm going to turn it back over to Hardeep to talk about Bolden Minerals.
Yeah, thanks, Mike. So I'm only going to spend a few minutes on this case, which is very interesting. So this case concerned the sale of this mining company in Finland called Kevitsa Mining by First Quantum Minerals Limited. That was a Canadian public company. The sale was for US $712 million, and it sold it to Boliden Mineral, which is a Swedish mining company. The agreement was governed by Ontario law. Under Finnish tax laws, Kevitsa Mining had a very significant loss carry forward of 81 million euro. Effectively, they had expenses that, losses in the previous years, which were able to be carried forward, similar to in Canadian tax laws. So the purchaser, if they carried on the same business, so that is Boliden, if they carried on the same business, would be able to use or have Kevitsa use those tax losses going forwards if the Finnish tax authority gave a certificate that it was okay to do so. And it had the discretion to deny that. So following closing, Kevitsa, of course, applied for this tax certificate from the Finnish Tax Authority and got it. So those expired loss carryforwards were in fact reinstated, and they were available for use in future tax years. About a year later, Finnish tax authorities audited Kevitsa, and they focused on a pre-closing tax years, so about 6 years before the sale closed, on a reorganization that happened at that time, and they found that there was some impermissible tax avoidance in that reorganization, and then that caused them to deny in future tax years 113 million euro in expenses that were claimed by Kevitsa, and so all of a sudden there were a number of tax years pre-closing, which became like taxable for income because Kevitsa had income as those expenses were no longer there to decrease that income. So the taxes were payable in pre-closing years, which meant that penalties and interest also built up. In total, Kevitsa exceeded, the assessment of Kevitsa exceeded 30 million euro. So FQM took carriage of the tax dispute with the Finnish tax authorities, ostensibly to argue that the reorganization didn't have an impermissible tax avoidance purpose. But then Boliden made a claim at Ontario Court, Supreme Court, under the SPA tax indemnity, which stated that any taxes required to be paid or remitted by the corporation or subsidiary, so Kevitsa, with respect to any pre-closing tax period, would have to be indemnified by the vendor, FQM. So in the alternative, so that at the same time, Boliden also claimed damages resulting as a breach of tax rep and warranty, that there are no reasonable grounds for reassessment of the corporation because the corporation did get reassessed. So FQM said, well, like we accept liability, like that we have to indemnify for pre-closing tax periods because it clearly says that. But they did not want to indemnify for those taxes that Kevitsa would have to pay in post-closing tax periods because they said that those years were not covered by the indemnity. They also argued that the tax reassessments were not final, and until they were final, there was no obligation to indemnify. There's a separate argument that there was a write-off of the tax losses prior to the sale, and therefore those losses should have no value, which did not work because all parties believe they did have value. In any case, FQM filed a motion to stay the proceeding that had been initiated by Boliden, and the motion judge declined and said, well, the commercial idea behind indemnity is based upon a substantially more real-time approach, which effectively meant that even if like some of those tax losses couldn't be finalized and finally determined, the vendor may have to indemnify, depending on how the trial went. In the later trial decision, the OSC they strictly interpreted the SPA, understanding that it was agreed to between parties that had retained counsel, that the SPA was a bespoke agreement, the parties were sophisticated, and on that basis, they said that the post-closing taxes payable by Kevitsa were with respect to pre-closing tax years, which is interesting because they were post-closing. However, because they were payable as a result of the disallowed expenses in pre-closing years, which cascaded so that in post-closing years taxes became payable, they did sufficiently relate to the pre-closing tax years. So they were covered by that indemnity. The Supreme Court also found that there was a breach of warranty. It noted that the warranty was not knowledge qualified and was simply incorrect because there were grounds existing for reassessment at closing. The parties may not have known about them at the time, but that's not a bar for the warranty or breach thereof. The loss caused the breach of warranty in post-closing was found to be an indirect consequence of the reassessment and was reasonably foreseeable that the loss may occur later. The judge noted in particular in finding this that it was known to FQM at closing that Boliden may wish to apply to Finnish tax authorities to reinstate the expired tax losses. And he's even made the comment that it would be crazy not to do so in that situation for any purchaser. So the FQM appealed to the Ontario Court of Appeal, which upheld the finding at the Supreme Court, Ontario Supreme Court. However, it did so only on the basis of the breach of tax warranty, and it did not comment on whether the pre-closing tax indemnity could extend to post-closing tax years. So a few takeaways. One has to be careful with tax indemnities because they can have a surprising reach, and they can, the impact of them could be felt for many years later. Sometimes some tax pools and some tax characteristics of a corporation can, like a denial of those, can lead to a cascade into subsequent tax years, and that can happen in Canada as well. Disputes over tax authorities can accrue significant interest and penalties before the time that they are finally determined. So it's usually important to address the issue in an SPA to say who's going to pay what when, and likely the purchaser will want the vendor to pay amounts that come due in respect of pre-closing years at the time that they're assessed, rather than waiting for a final determination. And the SPA should contemplate this. And I'll turn it over to Mike to close out our discussion about the GAR changes.
Yeah, thanks, Hardeep. And yeah, that bulletin, I think, goes to show, I think sometimes, the tax indemnity provisions are, obviously critical in SPAs and purchase agreements, but I think sometimes people conceptualize that it's a simple process, that if there's something wrong with tax, you get a tax bill, and then it's clear how much you have to pay and when you have to pay it. And the reality is it doesn't often work that way, and that it's not clear when it's due. You might have appeal rights. It's not clear what the impact will be given existing tax pools and everything else. So I certainly advocate, spending some real time kind of working through those provisions to make sure that they, are going to land with the result that your client expects. So GAR, we're not going to get into, GAR obviously really important, the general anti-avoidance rule, and lawyers love to talk about it, especially tax lawyers. We just want to kind of give a heads up that the GAR is in the process of being amended. The amendments are not yet in effect. There's been a lengthy kind of comment and review process with the legal community and the accounting community about the proposed changes. But yeah, this is the rule that for those of you who have not run into GAR, that we have all of these very specific rules in the Tax Act about what you can and can't do. And then sort of buttressing all of that is even if you're in strict compliance with all that stuff, if we think you've done something abusive, we can apply this rule to challenge your transaction. And so, when we're looking at planning, we have to sort of reckon with the GAR. The GAR, again, there's sort of three elements to it. You have to have a tax benefit, an avoidance transaction, and a misuse or abuse of the Tax Act. The tax benefit is usually pretty self-evident. So usually the fight's over GAR, whether you've undertaken an avoidance transaction and whether you've misused or abused the Act. So in terms of those, the government's announced, again, I think they feel taxpayers are not afraid enough, I think, of the GAR. And so they're putting a bit more teeth in it. They're now going to add a sort of an economic substance test to the GAR, which is something that the CRA has been kind of trying to do for a long time. Again, not a U.S. tax lawyer, but from dealing with U.S. tax, they do have a concept there of kind of more the substance of what you did as opposed to the form you did it. Canada has usually resisted that. So in Canada, if you've legally done something, that's what is going to be reflected for tax purposes. But we are sort of potentially incorporating a broader sort of economic substance test. So the impact of that, if it happens, I think will be significant. There also, again, one of the interesting things about GAR always was that there was no penalty associated with it. Like you could get your transaction redesignated, but there wasn't a penalty on top of that. So there was a sense that some taxpayers were saying, well, I'll roll the dice because if I lose, all I'm going to land is sort of land up where I would have been anyway because there's no penalties. So they are looking to add sort of penalties to provision as well. So it is possible that this could be effective as soon as January 1st, 2024. If it is, I suspect in one of the upcoming quarterly perspectives, we'll be probably doing a bit of a deeper dive on GAR, but wanted to give everyone a heads up that that's a big development in tax that is moving along. The final thing we just wanted to touch on, it's something we've talked about, I think, before, but it keeps going back to is, because we see it in M&A deals all the time, and that's international sales tax. And so in specifically in the U.S., as many of you might know, there was a U.S. Supreme Court decision back in 2018 that really expanded the ability of U.S. states to tax people for sales tax. And we're seeing all the time clients, particularly in sort of the tech space and whatnot, who have no presence in the U.S., no employees, no office or anything else, but they do have customers, and that is often enough to trigger sales tax obligations in those states. And unfortunately, many times that does not become apparent to the client until they're in the middle of a deal. And so what we're telling people, again, the reason the slide here is this is the world we live in now. If you haven't done so already, you should check to see if you're compliant. And certainly if you're going into a deal, it's good to get ahead of it and figure whether you have any issues here. So if you do have an issue, you then can craft sort of the solution into the context of your deal, whether that's a rectification process, special indemnities, other things. But again, just an issue that we're continuing to see repeatedly and unfortunately in the context of M&A deals. So we're at 1 o'clock now. We had one question, which I'll take just quickly, and that was with respect to the trust reporting. And that says, in terms of an escrow agreement, would the parties' filings be limited to the buyer and target, or would this include the escrow agent, like a trust company, holding the funds on the party's behalf? Well, Hardeep, I don't know what you think, but I think actually the party probably filing there is the escrow agent, because that would be the trustee of the trust who generally has it. Yeah. The buyer and target probably wouldn't have filing obligations, but what would be required is the escrow agent would need all that information that you talked about, from them. And so I think, fortunately, I think trust companies are on top of these rules and are aware of, their obligations. Where it gets trickier maybe is a law firm or a third party that doesn't normally act as an escrow agent who's agreed to take on that role.
Yeah, particularly a third party. I think law firms are understanding that they do have to report these things, particularly if they're held in a segregated trust account, as like law firms are required to report those anyways now. And they'll have to get familiar with those rules anyways, so they may be able to do so. But particularly where there's a third party that's not either of those, a law firm or an escrow agent, I'd be concerned about that.
Yeah, for sure. Thank you again for joining us. The next session in our quarterly perspectives is actually next month. So it's not next quarter, it's next month. But it's going to be a good one. I got a bit of a preview. My colleagues, Ron Ezekiel and Laurie Bokenfor, are going to be speaking on some interesting issues. So I hope many of you will be able to attend that as well. So thanks, everyone.
Yeah, thank you.